Paying for your parents' health insurance in India? Well, you may also be able to save tax. Welcome to This Explainer. Today, we're diving straight into a totally legitimate, highly practical way for non-resident Indians to optimize their Indian tax liabilities. So, if you've got financial ties to India, you're absolutely going to want to pay close attention to this one.
You know, many NRIs take on the incredible responsibility of paying health insurance premiums for their parents back home. And it's a fantastic way to get some peace of mind from thousands of miles away, right? But here's the catch. Many just don't realize there's actually a dedicated tax deduction available for doing exactly this under Section 80D. We get so hyper-focused on the care aspect, making sure mom and dad have the best hospital network, that we completely overlook the financial optimization side of the equation.
So let's get into it. If you are the one paying those premiums, you might actually be able to claim a substantial tax deduction on your Indian income tax return. Think of it kind of like a government-sponsored discount on your parents' health care. It's a huge benefit that often slips right under the radar. But by claiming it, you're essentially recovering a portion of that expense directly through your tax savings.
Okay, here's our quick roadmap for today. First, understanding Section 80D. 2. Figuring out if you have eligible income. 3. Calculating your deduction limits. 4. Looking at acceptable payment methods. And finally, 5. The claiming and documentation steps. Let's jump in.
Section 1. Understanding Section 80D. Section 80D of the Income Tax Act is a dedicated provision meant to incentivize folks to get adequate medical insurance. And by the way, this will broadly continue under the upcoming Section 126 in 2025. Now, the absolute vital thing to know here is that NRIs can claim these deductions exactly like resident Indians. You're not excluded just because you live abroad. It applies to premiums paid for yourself, your spouse, dependent kids, and most importantly, for our focus today, your parents. The government actually wants to encourage this to take the burden off the public healthcare system.
But here is the absolute golden rule. Only the person paying the premium can claim the deduction. Let me break that down. If the money leaves your bank account, your parents cannot claim the 80D deduction on their taxes. You have to claim it on yours. And interestingly enough, financial dependency doesn't even matter here. Your parents could be totally self-sufficient, drawing their own pensions, but if you're the one legally footing the insurance bill, you get the benefit.
Moving on to Section 2. Do you have eligible income?
This right here is the biggest hurdle. To use this deduction, you actually need to have taxable income in India. For example, you can't offset this against your foreign source salary because, well, India doesn't tax that anyway. Same goes for NRE account interest, which is already tax exempt. But if you have rental income from an Indian property, or capital gains, or interest sitting in an NRO account, that is totally eligible. So if you're renting out your old place in Mumbai or Bengaluru, this deduction is literally the perfect way to shrink the tax burden on that exact rental income.
All right, Section 3. Calculating your deduction limits. Let's do the math.
The limits are tied directly to age. If your parents are under 60, you can claim up to 25,000 rupees per financial year for their premiums. And keep in mind, this is an entirely separate allowance on top of whatever you claim for your own immediate family. It is its own dedicated bucket of tax savings just for mom and dad.
But the math gets so much better as they get older. If your parents, or even just the eldest parent, are senior citizens aged 60 or above, that limit instantly doubles to a generous 50,000 rupees. The logic makes complete sense, right? Health insurance naturally gets pricier as we age, so the tax code gives you a bigger cushion for those higher costs.
Let's look at the absolute max scenario here. Say you're a senior citizen yourself, paying for your own family. That's a 50,000 rupee limit. Add the 50,000 limit for your senior citizen parents, and your total combined family deduction can hit up to 1 lakh rupees in a single year. When you calculate the actual tax saved on 1 lakh of income at the higher brackets, the financial relief is no joke. It's incredibly significant.
Okay, Section 4. Acceptable payment methods.
So the key here actually isn't whether you pay from an NRE or an NRO account. What matters is the specific mechanism you use. To legally secure this deduction, you absolutely have to use non-cash methods. We're talking net banking like NEFT or RTGS, UPI, debit or credit cards, or even a check if you still happen to have a checkbook lying around in a drawer. Digital channels are definitely your best friend here because they leave an instant, highly traceable record for the tax authorities.
The tax department draws a very hard line here. Paying your premiums in cash completely disqualifies you. Literally, do not pay these in physical cash. If your parents hand physical rupees to an insurance agent, your tax benefit just vanishes.
Now, there is one tiny exception. You get a sublimit of 5,000 rupees a year specifically for preventive health checkups, and that can be in cash, but the actual premium, digital or paper bank trail, period.
Finally, Section 5. Claiming and documentation steps.
To actually pull this off, you just need to follow 4 clear steps. First, buy a valid policy from an Indian insurer. Second, pay via those digital channels we just talked about. Third, keep your premium receipts safe. And step 4, this is a big one, you must declare it while filing your return. Now heads up on a major detail. Currently, this deduction is only available if you opt for the old tax regime. You cannot claim Section 80D under the new simplified regime. So you or your CA will definitely want to run the numbers both ways to see what actually saves you more.
As for documentation, be sure you keep the premium receipts showing your name as the payer, the policy document listing the insured members, and your bank statement proving the transaction. You don't actually have to attach these files when you hit submit on your return, but maintaining a neat digital folder is crucial. I mean, we all know that sheer panic of digging for tax receipts the night before the deadline, right? Do yourself a favor, save them as PDFs right now. You need them ready just in case the taxman comes knocking for verification later.
Protect your parents. Reduce your Indian tax bill. By sticking to these guidelines, you hit 2 massive goals at once. You make sure your family is completely safeguarded against unexpected medical emergencies, and you smartly optimize your own finances in India. For any NRI with eligible income, this is an absolute win-win scenario. So, I'll leave you with this. Are you leaving hard-earned money on the table this tax season simply because of how you route your payments? Before filing your next return, review those insurance payments. Verify your eligible Indian income, double-check your payment methods, and please make sure you aren't missing out on these valuable deductions. Thanks for tuning into this explainer. Now go track down those premium receipts.